Manish Sonthalia joins us, Vice President Fund Manager with Motilal Oswal Asset Management. Manish Sonthalia, looking at the way how HCL Technology numbers have come out, is there scope for the pecking order in large cap IT to change now?
Yeah, looking at HCL Tech's numbers, I think Infosys was a stock specific case, and maybe more confirmation on this could be had from TCS numbers, which reports after market today. But clearly the numbers are better than estimates, whatever HCL Tech has reported, both on top line and bottom line. There could be a change in the pecking order. If TCS reports similar strong numbers, then I think it could be TCS, Infosys, and then the second tier IT companies.
Manish, HCL Technologies has always traded at a 25 to 30% discount to Infosys, about 35% discount to TCS. Why is HCL Technologies, or historically, why has the stock always traded at a discount to TCS and Infosys?
I think it has got to do with the size of the company and the revenue mix. IMS, which is infrastructure management services, do generally carry a lower margins, whereas high value added services which Infosys and TCS do, they carry a bigger margin. So it's about the size and the mix of the revenues which determines what P multiples you're going to get. So gross margins of Infosys are 45%, TCS is lower than that, and HCL Tech is even lower than that. So it's got to do with that.
Right, out of the entire lot, there has been, of course, a lot of institutional interest that's been there in HCL Tech, even as a stock benchmarking to Infosys and Wipro. EBITDA margins for the company have been able to come in at a higher level, 18.4% versus about 17%. So there's been traction there. They've been good at controlling costs and, of course, have managed the currency movements quite well. Manish, in that light, is there a target that you would hold on HCL Tech with the near-term perspective, 6 months to 8 months at that?
I think the valuations are quite reasonable. If you look at 1 year forward earnings, then maybe they are trading at closer to around 11.5, 12 times, which to my mind, a company of the quality of HCL Tech does warrant a re-rating, and traditionally we have seen that it trades at closer to 14, 15 multiples. So it's a good buy at, and not a bad stock to own at current prices.
Manish Sonthalia, given the way how money managers and traders are re-engaging in high beta stocks, are you looking at selling your pharma stocks, the FMCG stocks you own, the ITC, the HULs, the defensives?
No, not yet. I think you'd get ample opportunity to do that once a rate cut is effected. Obviously it's not happening in a hurry. January 24th is absolutely ruled out, and you have the whole set of results for the third quarter to come in for the infra companies, which in any case are not going to be that good. So I think closer to expectations of a rate cut, these rate sensitives, which includes your real estate and infra stocks, should see activity. So I think there's still time when you will do that. As of now, we are staying put with our consumer staples and discretionary names.
So Manish, what's been your portfolio strategy for 2012? Are you in a buy mode or are you still in a beware mode?
I think because it's a long-term portfolio, there's not too much of churning happening. I think we are still convinced that the consumer names are going to give decent returns. Of course, sector rotation would be taken once you have rate cuts being affected, which means that going overweight on rate sensitives. That is the sort of strategy we have mentally planned. And commodities clearly would remain an underweight for at least the first half of 2012. I think broadly that is how we would put it.
Manish, Depreciating rupee for the quarter gone by suddenly made IT stocks look attractive. Now that rupee is appreciated against the dollar, is it time to revisit IT stocks and ask that big question that in appreciating environment, will IT stocks they continue to outperform?
Yeah, you're right. I mean, the outperformance may not be there in the fourth quarter if rupee was to appreciate, and there's a whole likelihood that rupee would continue to trade between, let's say, 51 and 52. So it would be all boiling down to operational parameters, and traditionally the third and the fourth quarters are not very strong quarters. So I think a lot of the outperformance may have already been seen. Maybe at this given point in time and going forward, it may just be a market performer. So you're right in that regard.
Manish Sonthalia, the global economic growth is slowing down, crude supply is static, the outlook for crude is negative, rupee is appreciated against the dollar. These are factors which will have an impact on oil marketing companies and companies like Cain. So given the kind of backdrop we are in, why are you still bullish on Cain?
No, I mean, Cain is more of a volume story rather than betting on the oil price per se. What we are assuming is $100 on Brent for the next 3 years, and this 125,000 barrels per day, going up to something like 240,000 and then to 3 lakh barrels per day, means that you are looking at assured cash flows of 10,000 crores every year. Market cap is closer to 60,000 crores, and the proven reserves, which is 1P, is 1 billion barrels, which means the reserve size are there for 12-13 years. So basically you are getting an undervalued asset, even assuming that oil remains at $100, Brent remains at $100 to a barrel, and your net profit margins would be in the vicinity of around 20%, so 22%, 22 barrels per $22 per barrel would be your profits, and it's a volume story.
I know you own Cain, Manish Sonthalia, and the portfolios you manage. So my follow-up question is that what to your mind is the real price or the real intrinsic value for Cain, and at what price point you would like to sell Cain?
I mean, look, the 1P reserves are at 1 billion. You have a 3P reserves which could be in excess of 2 billion barrels additionally. So, there's some more work and that's basically coming from the Rajasthan fields, the Bama Hill fields. If you have confirmation that yes, there is a sizable amount of oil in the Bama fields, then absolutely there is no case of selling Cain at these prices. You're looking at multiples of current prices in the next 5-10 years. So that's the whole story. I mean, and there is no case of selling Cain currently. It has a long way to go.
Manish, Tata Motors and Maruti are two stocks that have been in focus. Tata Motors, of course, the JLR numbers are looking good. What would be your call here?
We're extremely bullish on Tata Motors. We own that in our portfolio. You saw the JLR numbers yesterday, 45% growth. I think analyst estimates on JLR volumes will keep on getting revised on the upside. So right now we are working with 350,000 for FY13. Maybe you could see an upside on that. So we are very positive on Tata Motors. We own that in some of our portfolios.
Maruti?
As far as Maruti is concerned, I think there were some reports. As far as Maruti is concerned, I think there were some reports today in the media, in the newspaper, saying that they're looking at hedging for their vendors. I mean, if that is done, then it takes away a lot of pain on the 30% imports which the company is doing. Because the problem of the company had been that yen has been appreciating and 30% is imported, and it's all yen denominated. And plus, if there's some resolution on the royalty, which is again yen denominated, and it hits the bottom line and the minority shareholders, you could be looking at expansion in margins. But I think between the two, Tata Motors looks like a more compulsive bet at this point in time.
All right, Manish, we let you go at that. Thanks very much for joining us this morning and giving us your sense of the market and also sectors and stocks that you like.